Good morning to everyone out there, or good afternoon, and maybe afternoon in some places. Today we are going to get into a state and local tax update. And so the topics for today are across a realm of different state and local tax topics. And there's a ton going on right now, just this time of year. This is when the legislative sessions at the state level are ending. Some are still going, but tying up. But this is where we tend to see all of the big tax bills come out. And there has been a lot going on. And just with the pandemic and certain other things going on that we're talking about, this is maybe an unusually more busy year for state legislation than usual. So ton going on, a lot to cover in an hour. So we'll move at a fairly fast clip, but we'll be open for questions if you want to submit them over the Q&A or follow up with any of the presenters afterwards. So quick introduction of our presenters today. So I'm John Gupta. I'm the principal in charge of the state and local tax practice for EIde Bailey. I have been here coming on a year after about a 25-year career with a big 4 firm state and local tax practice. So really enjoyed that transition in my career and really enjoyed getting to know EIde Bailey as a firm and the team and the clients as well. With me have Dylan Lean. Dylan has about 17 years of experience. He's a senior manager in our Minneapolis office. He fairly recently joined us too from a big 4 firm. He also had experience before joining that big 4 firm with the Minnesota Department of Revenue. So he was on what we call the dark side as state and local tax practitioners, but luckily he's seen the light. Last and absolutely not least, we have Iris Chung. Iris is a senior manager in our Washington, D.C. office. She has about 18 years of experience too, spanning between big 4 and also working within the tax departments of some large corporations. So between us all, we have over 60 years of state and local tax experience. So hopefully we know what we're talking about. We think we do. So, and one thing I wanted to mention at the second to last slide, all 3 of our contact information is there, our email addresses and phone numbers. And so feel free to reach out to any of us with any questions at any time. And you can also find our SALT group on idebailey.com. So this is our agenda for today. Like I say, we have a ton to go through here. I'm going to do a quick run through of what I call the state of the states, and I'll explain what I mean by that in a minute here. And then Dylan and Iris are going to talk a little bit about what's going on in the world of Nexus, which always is a big topic, obviously, for state and local. And then Dylan and Iris are going to talk about developments in the sales and use tax world and income tax world, respectively. And then we'll wrap up, if we have the time, just what's a little bit of a look ahead and maybe some predictions around where things are going in the state and local world. So as I mentioned, I wanted to talk quickly about the state of the states. And I like to do this at the beginning of any of our kind of comprehensive state updates, because really getting kind of an understanding of the financial picture and the budgetary picture among the states is important to have the context as to why states are doing what they're doing from a tax policy perspective. And so I wanted to talk a little bit about that. I think coming out of the pandemic, we have some very unusual circumstances that states are facing, probably most unusual I've ever seen in my 25 career. So again, I think it's important to just have a little bit of context before we get into specific developments. So want to talk a little bit about the state budget picture, where we find ourselves at the moment. As I mentioned, this is probably one of the most unusual budget situations that I've seen the states be in. And before any conversation about state budgets, we always have to mention that unlike the federal government, the states have to annually balance their budgets. So as we all know, the federal government does not have to balance its budget and can print and has been printing a lot of money. So states can't follow that. If revenues are going down, they've got to adjust by reducing expenses. And so puts a lot more pressure on the state. So at the outset of the pandemic, there was pretty dire predictions. And I think as a consensus, and myself included, we all felt that the states were going into a very dark place from a budgetary perspective. The consensus prediction at the outset of the pandemic was that there'd be 40% revenue declines for the states, which would be significant and potentially, result in defaults and things like that, which have happened at the state level before. But actual results were a 12.1% increase in state revenue from the fiscal year pre-pandemic to the fiscal year pandemic. So that's pretty crazy. And how can that possibly be with the lockdowns and what happened to the economy at the beginning of the pandemic? Well, sales tax collections, which is probably one of the most significant revenue sources for the state, actually increased during the pandemic. And despite all the lockdowns, there really wasn't a reduction in retail sales activity. In fact, there was an increase, and it just moved online. And Dylan is going to talk a little bit about WAYFAIR in a moment, and the states couldn't have asked for better timing on that. WAYFAIR essentially allowed the states to require online or remote sellers to collect in the same way that brick and mortar businesses do. And those laws changed right before the pandemic. Had they not, we'd be talking about a much different situation, but really it was just a matter of the tax base or the retail activity moving online. Personal income taxes weren't impacted nearly as much as the states thought, or we all thought, and that's because higher income workers who bear the brunt of creating that revenue for the state really weren't impacted by the pandemic because they were supported by remote work technologies. The job losses that we've all heard about were really more with lower income workers. So personal income taxes actually increased and incomes increased, and property taxes too. While there was a reduction in commercial property because of reduced office space, that was greatly offset by residential property valuations continuing to increase. So really interesting. In my 25 years, as I mentioned, this is a pretty new thing because it's always been the states struggling with their budgets and finding ways to balance those budgets. You have your serial offenders like California and Illinois who are constantly behind budget. Here, California, we were predicting a $50 billion deficit before the pandemic, ends up with a $15.5 billion surplus. So on top of that, the federal government is based on some past worries about how recessions impact the states. In the American Rescue Plan, which was signed by President Biden in March of 2021, gave an additional $350 billion to the states to work with. So the states are just awash with cash right now. So that $15.5 billion surplus, just as an example that California had, add another $42.6 billion of cash on top of that, they don't even know what to do with it. So you've got the states sitting here with tons of cash, and a lot of that federal aid that they have has not been deployed yet because the states really don't even know what to do with it. So it'll be interesting to see what happens there. One thing that has not happened is the states using that money for tax cuts. And that is because within the American Rescue Plan, there was a restriction on the states that basically said that the states could only spend the money and not use it to reduce taxes. The states obviously didn't like that. They saw that as an intrusion on their sovereignty to do what they want with their budgets. So there's probably about 20 states in 6 different lawsuits that have filed suit in federal court to say that that's an illegal condition within that rule, and we'll see what happens there. But for now, the states are very worried that if they are seen as taking that money and reducing taxes by reducing rates or whatever else in terms of tax cut, that money gets clawed back. In the last week, the Senate budget resolution, there was an amendment that was added that was approved by an 86-13 vote to do away with that condition. So chances are that may not be with us very long. But between that and the lawsuits, we'll keep an eye on that. So this slide really is just, I can't touch on everything here, but hopefully it's helpful. I kind of laid out some of the things that are really big from an external environment perspective that are impacting legislative priorities. And won't touch on all of these, but the key here is that the state budget picture is better than ever between increases in revenue during the pandemic, which were a big surprise to everybody, plus the federal aid. but that money is not translated into tax cuts because of that chilling effect from that condition that I mentioned. There's, of course, been very little in terms of tax increases, except a few states who don't really need the revenue, but are just kind of in line with this movement toward income equality. You see it a lot in discussions at the federal level. They're happening at the state level too, where there has been some tax increases really targeting more of the wealthy and larger, closing loopholes and increasing taxes for larger corporations. So we've seen New York, despite like all the other states being awash with cash and not needing the revenue, increasing taxes on more well-to-do people, which may not be such a great idea given that there's a newfound ability for people to move and essentially vote with their feet in terms of taxes. So, and that's another big point that's out there. The impact of remote work is having a huge impact on the states. They have essentially had fairly business-friendly policies, which they are now coming out of because they're coming out of the pandemic, and they were kind of letting businesses have some breaks during the remote work on Nexus and people being in new states creating new obligations. Well, they're coming out of that, so that's changing. Iris is going to talk about that in more detail. But the other piece of it is that the states of certain jurisdictions, such as New York City and some of the other localities where people are not coming into offices in the city but are working at home, have lost tax revenues as a result of that, and that's not going to come back. And so they're passing laws and enforcing provisions to kind of protect that tax revenue. So, and then finally, and this is a big, probably one of the biggest topics coming out of the legislative session, is the state's responses to the federal cap on the SALT deduction. So in the TCJA back in 2017, that bill put a $10,000 cap at the individual level on state and local tax deductions. And the states have reacted with a workaround that the IRS has blessed by shifting that tax liability from the individual to pass-through entities. And there were about 7 states before this legislative session that had such a thing. 10 new ones have adopted them. And so we've got about 17 states with another 5 that states are considering right now. So big planning opportunity, big, a lot of conversations going on around that. So Iris is going to talk about that a lot more. Just a couple of quick notes on administrative environment. So one thing we've seen is that the revenue departments, just like all businesses, have experienced the same hiring and retention problems. What we saw was during the pandemic, a lot of older state employees left and began to take advantage of their pensions. And so there's a lot less experienced people out there and younger people that we're dealing with. And as far as state auditors go, we're dealing with a lot less experienced auditors, which may sound like a good thing, but generally, if you've dealt with a young, inexperienced auditor, you probably agree that's not such a good thing. But that is clearly happening. And from the standpoint of audit activity, we are seeing, and I think we're on the verge of a fairly significant, I shouldn't say fairly, probably a massively significant increase in audit activity around Nexus, auditors enforcing their new WAYFAIR provisions, and also residency issues connected with people moving related to the pandemic. So, those are just some thoughts on kind of where we are with state tax policy, and hopefully that's helpful to kind of create some context as we get into some of these more specific provisions. So with that, I am going to turn this over to Dylan, who is going to take us through some updates in the sales and use tax world and Nexus. And then I think after that, Iris is going to get into income tax provisions, and then we'll wrap it. So Dylan, you want to take it over?
Yeah, absolutely. And thanks, John, and thanks everyone for attending. So oftentimes when I have these updates, I find it fairly helpful to level set as to what Nexus is, because John had touched on it and talked about it a little bit, but let's talk about what it is, where it was, and where it's going, because there's been a lot of upheaval in the Nexus realm in the past 3 years. So basically speaking, Nexus is just a connection. In the tax world, we use it as a connection to a state. If you have enough of a connection to a state, that state can subject you or your business to that state's laws. So when you hear Nexus just think that you have a filing requirement or you might have a collection requirement. And from a sales tax perspective, the law of the land has always been physical presence, as in you had to physically be in the state. And that took the form of an office or employees or inventory in that state. And the easiest way to trigger Nexus is to permanently be in the state that you have that office or that employee. But you can also trigger physical presence Nexus just by temporarily being in the state. Visiting the state 2 or 3 or 4 times a year can be enough for a state to assert Nexus and say, yep, you have Nexus, you have a filing and collection requirement for sales in our state. And this all changed in 2018 with the landmark Supreme Court case, South Dakota versus WAYFAIR. So when you hear the term WAYFAIR, we're talking about economic nexus. And this journey started in 2016 when South Dakota passed an economic nexus law stating that if you have over 100,000 in sales or 200 individual transactions in our state, we are going to assert nexus even though you're not physically in our state. There was obviously a pushback on that provision that was passed in South Dakota. It made its way up to the Supreme Court. The Supreme Court ruled that, in fact, this was a valid law by South Dakota. It was constitutional, and South Dakota was able to impose economic nexus. And then all of the other states were sitting on the sidelines and watching in anticipation of this. And once it was found that South Dakota's law was valid, every single state as of June 2021 that has a sales tax has implemented economic nexus provisions. So the South Dakota law was kind of used as the baseline, as in the 100,000 or the 200 individual transactions. Other states have either imposed that or their thresholds are a little higher, say 500,000 in sales in Texas or California. And that sales number is typically a calendar year, but it can also be a rolling 12 months as well too. And so from this presentation for the sales tax side, the one takeaway is you should be looking at not only your physical footprint, but also your economic footprint as well too. And not only just looking at it once, but kind of continuously monitoring it as well too, where you might not have triggered Nexus in Minnesota last year, but maybe you had a good year and sales were up and you might have a filing requirement. So again, it's something that's, periodically, at least every quarter, taking a look at your sales footprint. I have a bullet here for enforcement dates. It's been, a little bit over 3 years now since WAYFAIR was ruled on. A lot of states came online in early 19, and so we're running up on 3 years of having economic nexus provisions, and that's important because a lot of states' statute of limitations when it comes to how far they can look back on an audit is 3 to 4 years. So we are expecting some increased audit activity just to kind of capture those first periods of when people were registered and filing. But it should be noted that if you're a non-filer in a state, states can go back indefinitely. Granted, they'll usually cap it at 6 or 8 years. But again, we're seeing a lot more activity in this space. We were expecting it last year, but with the pandemic, I think a lot of Department of Revenue has kind of clamped down and just worked on old audits and not initiating new audits. And again, physical presence is still active. States are still looking at it. So although you might have crossed an economic threshold in 2020, you might have had physical presence back to 15 or 16 by just going to a state, delivering goods into that state with your own vehicle. And then one other provision that was kind of paired with economic nexus was this concept called marketplace facilitators. Basically, states said, well, with eBay and Amazon, are we going to audit the 25,000 sellers that are on this platform or more? And they're like, well, that doesn't make a lot of sense. So they passed laws that said if you host an online marketplace and you are the collector of the funds for the sales on that marketplace, you have the collection responsibility. So if anyone on here is a seller on Amazon, you'll see that Amazon typically takes care of the tax for you because they have to. But just be aware that if you have your own website and you have third parties selling on your website, that you might have a collection and remittance obligation, even if you're not a traditional eBay or Amazon. And then Iris is going to touch on some of the Nexus activity that's going on in the income tax world, as there has been some real movement here in the past few months.
So on the income tax front, there is a public law 86-272 that was passed back in 1959. Back at the time, they were addressing a compliance burden for catalog companies that had sales representatives that traveled through the 50 states. And at that time, the law said that income tax filing isn't required for companies that just are sellers of tangible personal property, and any activity that occurs in the state is actually just sales solicitation or related to sales solicitation and doesn't involve warranty, doing warranty, other services, or any other type of extensive advertising in the state. And that the companies that fall within this protection would not be required to file for income tax. So what happened in August of this year was that the Multi-State Tax Commission, which is a body, non-governmental but nonprofit body that tries to issue uniform statutes for state apportionment, allocation, all aspects of state tax for states to adopt, they adopted some specific guidance that incorporates intranet sellers of tangible personal property and a list of activities that are unprotected. So they're actually reaching in and saying that beyond just the mere sales solicitation of just sales representatives, if you do anything beyond that on the internet, including placing cookies on a customer's computer to adjust information on how you do business, that could be an unprotected activity, which would break the 86-272 protection, which means you'd be required to file for income tax purposes. Granted, this has been a protection that over time has been kind of whittled away, and given the way the businesses do business in different ways or providing services, they may not have met this protection. So it's even further peeled away. One other aspect that comes up is the streaming of videos and music to electronic devices for a charge. That's an unprotected activity. Also soliciting online applications for credit cards, which generates fees for certain finance companies, interest, income, and fees. That's unprotected activity. So it also having electronic chat, which occurs on a lot of businesses' online websites, that also is an unprotected activity where there's interaction through the website with the customers, on real time. So protected activities are just your strict catalogs posted online where you can order with a static website with no interactive components, or a cookie where you're just merely keeping a customer's shopping cart items and perhaps sending reminders for them on whether or not they're still interested in purchasing what's in their shopping cart. So this is something that has been adopted as guidance for the states, for the states to enact potentially. It's been said that 22 states would be enacting it. So this is something to look out for and something that you might want to consider in terms of your state tax compliance going forward. So at this point, I'll turn the discussion back to Dylan on the sales tax.
So before I get to a few updates, I just wanted to kind of talk about issues that our clients are facing and maybe things that you need to be thinking about. So Nexus considerations, again, just looking at your footprint. I kind of went through it in a little bit more detail, but periodically just taking a look at your physical footprint and your economic footprint as well too, to see, do I have additional filings? And then if so, what do I need to do? Do I need to register? Should I look back at my past exposure? Should I maybe do what's called a voluntary disclosure agreement where I pay that back exposure, but hope to get out of penalties and a limited look back period. And then in addition to Nexus, documentation or data issues. So in a typical sales and use tax audit, and I've been on both sides, either doing audit defense or being the auditor myself, about 90% of the time really is dealing with the documentation or data issues. It's not so much the technical arguments as much as it is finding exemption certificates, finding invoices, or reconciling the underlying data that is used to report sales and use tax. And I bring this one up because I've seen a lot of clients that had a process put in place 7, 8, 9 years ago for collecting and remitting sales tax. And then that process just moves from person to person to person. And no one's really kind of looked at the underlying data to see if is the data correct? Are we double counting sales? Are we counting all of our sales? And it's just something to think about, looking to maybe look at a month and look at some sample transactions and follow them through and to reconcile it. You'd rather be proactive in that regard than reactive in an audit setting. And in line with that, item taxability, sales tax is challenging. I bring up an example in my home state of Minnesota where bowling shoes are exempt clothing, but golf spikes are taxable athletic wear. You can't really make this stuff up. And we see these in the food space and software versus software as a service. And again, maybe you looked at your item taxability 5, 6 years ago and haven't addressed it recently because laws changed. So you might want to take a look at that. And I've also seen where products change, where you might have coded something as downloaded software and the product might have changed to a software as a service model, but yet the taxability wasn't updated because those two are treated very differently when it comes to taxability. And then process and staffing challenges, just see this a lot. Tax departments are expected to do more with less. And so here I'm sitting here saying, well, you should look at your Nexus and your documentation and your taxability. And it's like, where do you find the time when you have to get these returns out the door every single month? So I definitely appreciate the challenges that a lot of people on this call are facing, and happy to help for sure. Because again, just the day-to-day compliance is a lot. Nevertheless, looking at these and being proactive with these other challenges that you might face. So now I'll kind of jump into some of the changes and trends that we're seeing in 2021, or at least over the past few years. So new city and district taxes. So this was occurring before the pandemic, but it's definitely looking like it's speeding up in the fact that a lot of cities or local jurisdictions are looking to, they might have an initiative where they're trying to fund housing for the homeless. And so they need to come up with that revenue, and they can come up with the tax that can then be earmarked for that initiative. Well, then they might have another initiative, and then you start getting taxes piled on top of each other. For example, Chicago has 28 different taxes. I had a retail client that was under 5 different audits of different tax types, where the reporting's different, the methodology is different, and so you just kind of need to be aware, especially if you're entering a new market. We're seeing this in the major metropolitan areas the most. And so if you're entering a Seattle or a San Francisco, especially if you're going to have an office there, it's something you definitely want to look at. And also, cities are having additional licensing that's required to operate in that city too. So just be aware, if you're going to open an office, there's probably a lot of work to be done to make sure you're in compliance. States are still looking at pre-WAYFAIR periods for physical presence, specifically this fulfillment by Amazon. We've seen a couple of states actually send out notices for Amazon sellers who utilize the service by Amazon, because Amazon's fulfillment might have moved your inventory into, say, a Pennsylvania or a California, and those states have the records of Amazon due to their own audits of Amazon, and just went on the list and sent out automatic notices to sellers saying, yep, you have a physical presence in our state, you have a requirement to collect. And so more states will probably jump on board with this as well too. So if you're using this FBA service by Amazon, you might want to just look to see if you can see where your inventory has been going, and if you are compliant in those states. And then there's always this continuation of tax laws catching up to the digital world that we live in. Digital advertising tax, which I'll touch on in the next slide, is becoming kind of a trend. Also cryptocurrency as well too. States are addressing how they should not only handle it from an exchange perspective, using crypto to buy tangible personal property, but also the industry itself. I think it was Kentucky passed some incentives for Bitcoin mining equipment to be exempt from sales and use tax. And so I think states will continue to address this as it becomes more prevalent in our economy. And then virtual services, just, you know, in the pandemic, how we facilitate services has changed in a lot of respects, where services that might have been face-to-face are now virtual. And that provides a kind of a challenge, especially if a service provider like myself is in Minnesota and you are in California on the other end of receiving my services. How do you source that? Who gets the tax if it is actually a taxable service? And so again, it's just something that states are trying to get their arms around. And then also a lot of states implemented temporary COVID rules, either waiver or penalty for late filings. There were also some Nexus provisions if you're had people temporarily working from home, and when are those going to end? How is that going to roll off? You know, we kind of had expected some of those provisions to start expiring, and in some states they are, but other ones might continue into 2022 as we continue to wrestle with the pandemic. As I mentioned, digital taxes. Maryland recently passed legislation to tax digital advertisers, but this was targeted to large companies, 100 million in global revenue. And you can imagine the companies that they were looking to tax. Now, there has been a little bit of litigation in Maryland regarding this, because again, I think some of these large companies are trying to cut this off so other states don't adopt it. And so this has been pushed back to 2022, and a lot of states are kind of sitting on the sidelines saying, okay, you know, where is this Maryland law going to land? And you know, if it ends up being valid law, can we adopt something similar to at least tax these large taxpayers? But also that threshold might continue to you know, erode and go lower and lower. Massachusetts, this is kind of a troubling trend, accelerated tax reporting. Accelerated tax reporting isn't new in this aspect that some states would have maybe an annual acceleration in June where you have to make a prepayment. But Massachusetts, for their large taxpayers anyways, who have 150,000 in tax that's collected in a given year, they are kind of forcing them to make an early payment. So for the sales of the first half of the year, you need to make a payment by the 25th, and then make a subsequent payment, a true up afterwards, because they're trying to accelerate that kind of that money that's sitting in someone's, you know, account for tax collected. And then PPE exemptions as well too. Some states had some temporary provisions, and Virginia recently enacted some exemptions for protective equipment that is going to be on the books until announced otherwise. And you know, again, by now we were hoping that we were probably out of the pandemic, but we shall see how long these provisions last. Another fascinating one is in Pennsylvania. So prior to the pandemic, a protective face mask, for the most part, was taxable. There were a few instances where it was not. But if you went into a Target and you bought a cloth mask, it would be subject to tax because it wasn't considered clothing, and Pennsylvania exempts clothing. Well, during the pandemic, when masks were required to be mandatory, masks now became general use wear, right? It wasn't just painting your garage or mowing the lawn or something like that. You had to wear it every single day, and it became like a piece of clothing, like a t-shirt did, or you know, shoes. And it's kind of a fascinating kind of twist to this story from a tax perspective. So it'll be interesting to see how states deal with this on audit as well too. You know, especially there's a handful of states that have an exemption for clothing, and whether retroactively they're going to say, yep, it was clothing, or no, it was still protective equipment, which is generally subject to sales tax. Another area that's kind of been kind of an uptick is sourcing for sales tax. So for interstate sales, it's always destination. Basically, if I'm Minnesota and I sell something to someone in Houston, Texas, the Texas tax is going to apply along with the Houston local tax. But a number of states do have what is called origin sourcing for intrastate sales, where if someone is a seller in Dallas and they ship it to Houston, well, they're supposed to collect the Dallas tax. And this is kind of, there's been some games that have been played in Texas when it comes to this local tax sourcing. there's this concept of revenue sharing where a company might set up a sales office in a local jurisdiction and say, we'll set up here as long as you share some of the tax revenue with us. This is completely legal in Texas, but they're trying to kind of chip away at this activity where the actual items aren't being shipped from a facility. Instead, it's just like a sales office, and they're trying to source the sale to that location. New Mexico has also been addressing sourcing. So New Mexico had a weird provision where they would source services based on the location the service was actually being performed versus kind of a destination, which matches, most other states. And so July 1st, 2021, they switched their sourcing regime for services to be destination based. And then they also did some other sourcing cleanup as well too. And then Colorado, anyone who does sales and use tax for your organization or is a consultant knows that Colorado is at a minimum one of the 3 worst states when it comes to sales tax compliance, and might be the worst because it's so challenging because of their home rule jurisdiction, where home rules such as Denver or other cities they impose their own tax. They can have different taxability than the state, and they have their own returns. Additionally, Colorado historically had an origin-based sourcing for intrastate sales. And so there's been a movement to change that to destination-based, with a lot of taxpayers actually being on destination-based already. But they needed to, Colorado adopted an emergency provision this year to extend the exception to small sellers under 100,000 to 2022. So those sellers can choose to still do origin-based sourcing. So they're buying them a little bit of time because it seems like there were some issues with those small sellers getting in compliance with that. Then just a couple interesting court cases. Pennsylvania, this is with the face masks that I previously talked about. This was a class action lawsuit where an individual went to Aldi and Dollar General. They were charged sales tax on these face masks. And so they instituted a whistleblower lawsuit, basically certifying a class that was trying to kind of, have kind of a class action lawsuit for these companies that incorrectly overcharged them tax. So this individual, the tax that was overcollected totaled 45 cents and 35 cents. But as being part of a class action lawsuit and a whistleblower, they're entitled to get some of the recovery of that whole entire class if they were to prevail. And in Pennsylvania, this plaintiff did not prevail because the federal court ruled that the retailers weren't acting deceptive. They thought the masks were subject to tax. They put it on the invoice, and then they turned it over to the state. So these retailers weren't enriching themselves by collecting tax. But in Illinois, there's kind of a flip side where there was a class action for big box retailers who installed appliances, and this one specifically Lowe's, who was stating that they were a contractor and accruing tax at the contractor level versus as a retailer. And this one was different because it wasn't just Lowe's getting the tax incorrect. It was that they should have known better. In the case itself, the judge, said that their consultants said that they should have been classified as a retailer. The state of Illinois sent them notifications saying they should have been a retailer, but yet they ignored those kind of notifications and still continued to act as a contractor. And therefore, the judge didn't take too kindly to that and said, yeah, they were actually involved with deceptive practices. And, they're going to be on the hook for some penalties and interest as part of, doing this practice and not listening to their advisors. So another takeaway, listen to your tax advisors. So
I'm going to cover some of the income tax components and picking up on what John and Dylan have been talking about related to 2020 and the COVID pandemic. Lots of states had offered relief for businesses as well as individuals by offering extension, deferrals, further extensions, payment deferrals. California was one that allowed payment deferrals of sales tax. States also offered unemployment insurance relief so that the workers that became unemployed, that were claiming benefits, that didn't count against the employer's rate, further increasing their unemployment rate. Credits were also offered. California has what's called a Main Street Small Business Hiring Credit, which they also extended, and I'll go into some of those details later. Oklahoma had a business relief program, which was a grant that's been closed, fully, I guess, utilized by its applicants, but that was a grant relief program. Waivers of penalties also were granted and continue to be granted to the extent that returns were filed late and payments were made late on property, sales and use tax, income, depending on the state. One other aspect of what states did was they ignored the location of where workers working outside of normal, outside in different states as a result of the pandemic. So these state policies that ignored where the location of workers had to do with not having those employees in the remote state creating nexus for the employer. So in certain instances, the employers were not considered to be doing business in the state, wouldn't be subject to the minimum taxes. They didn't exceed 86272 protection. There were a number of states that indicated 19 states that said that the shelter in place rules wouldn't create nexus or changes in apportionment calculations. The no employer nexus Massachusetts waiver will expire in September 13th of this year. The other aspect is that as part of apportionment, that the employee's payroll doesn't count towards the payroll threshold, such as in California, Connecticut, and Alabama that have them. So there are about 20 states that still impose three-factor apportionment formulas. So this, not including the payroll in the factor, does have an impact on the income taxes owed. What has come out of this? Remote working isn't going away, as we've indicated. It's changing how we work. And as a result of changing how we work, employers have to be smarter about staying on top of what's occurring with their employees. One of the most maddening things about, I guess, complex challenges that employers have to deal with is a transient employee that works in 4 or 5 different states, may not even work in the state in which they're based. So it's still continue churning state tax footprint, monitoring where the rules for an employer, where they need to withhold for an employee, business filing obligations that also encompass the income tax filing obligations. As we had noted before, there's cross-pollination of information. So where an employer actually applies for withholding, that may trigger automatically an income tax filing notice. And then the unemployment insurance registration will also do the same. So those are very key physical things that the registrations that the states will identify as creating potential sales tax compliance or income tax compliance issues. The problem with these, the changes, is that the relief that we received during the pandemic is ending soon. So as we've indicated, employers are going to be impacted because the factor presence thresholds now may take into account those remote workers starting this year or ending last year. If the employees' at-home activities can cause a loss of the public law 86272 protection that we referred to earlier. And then the apportionment will also change as we look. There's still a few states that consider and look at cost of performance as a measure of what the sales factor would consist of. Most states are looking and source based on market. So then the other considerations are property and payroll. So employer withholding responsibilities, just mentioned that as I said, for someone in HR and in accounting to get a handle on where their workforce is actually working, that's essential with employer withholding responsibilities. And most states, 24, actually require withholding based on just one day that an employee works in the state. So this is a major tracking issue related for employers. And there's been a Mobile Workforce State Income Tax Simplification Act that was proposed back in 2012. Still has not passed, but originally it was to allow for at least 30 days of a waiver for an employee working in the state, just only under 30 wouldn't trigger withholding tax responsibility. So that unfortunately has not passed, and it also kind of reinvigorated itself through the HEALS Act, adding certain COVID-19 provisions, but that has not been adopted as well. So there's political climate that is precluding the push forward. I think businesses are for it. States are probably for it too, because this becomes an audit issue that they need to devote time to. Without this, we're still in the land of various state rules. You know, how do they work? And a lot of our consulting from the employer standpoint and the individual standpoint is how do we get a handle and what is the proper way to comply. So from an individual standpoint, with a remote working situation, a client may end up finding that they have a domicile in state 1. In state 2, they've created statutory residency, which is typically states have 183 days spent in the state plus a permanent place of abode. Which often involves in permanent place of abode is one with a kitchen and heat and a bathroom. So it's easy to trigger, given in 2020 where a lot of remote workers might have spent 6 months or more in a state. And the risk of actually getting double taxed and not being able to claim a credit for those taxes paid in the other state, because a lot of states, most states, say that your wages are sourced to where you actually perform the work. So counting days and tracking where an employee may be from an individual standpoint will drive the requirement to file on the state level on an income tax, individual tax level. So counting days is very important. And also if you're actually changing your domicile is to have that, you know, well documented, because there's many factors that are considered in whether or not a person has changed domicile. So a couple new pieces of legislation related to this is Arkansas just passed a law requiring that non-resident income is allocated to where the employees perform the work. Arkansas previously had a law that applied a convenience of the employer test, which meant that the employer's primary location for that employee to work. So a dedicated primary location was where withholding would be withheld, despite the fact that the employee might be working in another state. New York is another state that also imposes this rule, and there's a handful of other states, Connecticut, Delaware. So Arkansas has changed its rule so that you are actually required to allocate to where the employees perform the work. Kansas has almost essentially adopted a convenience of the employer rule option, where the employers can withhold based on the primary work location, not where the employee is teleworking from. In California, this is the Main Street Business Hiring Credit that I referred to earlier. This has been extended into the 2021 tax year. Last year, applications were required to be in by January 15th of the following year. If California follows suit with those rules, then it would be January 15th of 2022 that you'd need to to apply by. The program is actually more liberal. It's actually more inclusive because a small business is actually 500 or fewer employees as of the end of 2020, as opposed to the prior definition was 100 or fewer. A 20% decrease in gross receipts from between 19 to 2020. The prior, I believe, was a 50% decrease. The credit benefit is $1,000 per employee, and there's additional credit if you hire the homeless. Another recent, for the individual tax side, a lot of states have been consistently going after high income, wealthy individuals, questioning domicile. New York recently just sent out, as of this year, 150,000 notices, audit notices, and they are actually pursuing people with making annual incomes of as little as 100,000 a year. In the past, it's usually audit triggers were income wages of $1 million or more, but the state is being a little more aggressive, and we don't see New York as being any different. We think that other states are going to also continually seek audits of the upper middle class. So pass-through entity level taxes, as John had mentioned, this was part of the TCJA, that there was a cap put in place on the federal individual income tax returns, limiting the deduction to $10,000 in state taxes, which includes withholding, property taxes, sales taxes, income taxes. So easily that was a cap that a lot of individuals exceeded. So you didn't get a benefit of a reduced rate on your state taxes by receiving a federal benefit. So these tax structures were informally called state SALT cap workarounds, and it depended on whether or not the entity level taxes were taken into account in the limitation on the individual side. And that depends on whether certain states, such as Connecticut, pass their pass-through entity tax, but they also, in anticipation that the federal would be able to would allow the deduction at the entity level. So this was the IRS notice that came out in November of last year, clarifying that basically the deduction was permitted, full deduction was permitted at the entity level. So as I mentioned, in Connecticut was one of the first to pass their rule, and it's mandatory. So at the pass-through level, there is a 6.99% tax imposed. And then for tax years beginning in 2020 and prior, Wisconsin, Oklahoma, Louisiana, Rhode Island, and Maryland also have their own. All of the others are elective. So this is a good time to determine and look at our clients to see whether or not, and businesses to see whether or not this would be a good election to make. These tax provisions, and there's now 18 states that have passed, have some type of pass-through entity in place, tax in place. So they differ. They differ as to the types of entities that apply. Do your grantor trusts, can they claim this entity level tax and make the election? S corps, partnerships, and LLCs treated as partnerships typically are the entities that can make the election. Then the owners differ. In some cases, the states require that the owners only be individuals, trusts, and estates. In others, the pass-through entity election can be made by entities that are owned by C corporations. There is also an option in some states that individuals and trusts and states can opt out, whereas certain members can elect and stay in the election. Others say it's binding on all owners. So another piece of this is, since most states, almost 30, enforce a composite and withholding tax requirements on non-residents, that can go away and actually be severed once you make the election for the PTE tax, the pass-through entity tax, which in that case could require non-residents to file a return. So that could be a deal breaker for many situations. So I know I've run out of time in terms of discussing. I'll just leave you with this point. Effective for tax years beginning on 2021 or later are Alabama, Arizona, Arkansas, California, Colorado, Georgia, Idaho, Minnesota, New Jersey, New York, Oregon, South Carolina. Arizona is not going to affect until 2022. New York actually starts in 2021 with an estimated tax payment required by October 15th. So just today, they said they'll be coming out with rules, regulations, at least rules showing how to apply for that election. Okay, so I'll just indicate, just looking ahead, we have, as we've mentioned, there's going to be ongoing legislation addressing high-income workers. Washington State just passed a capital gains tax on individuals related to Washington-sourced income, and that hits with a 7% tax rate. There's a growth in the Zoom economy, which means that there's going to be a lot more policies around trying to capture that internet, the actual remote economic nexus thresholds will continue to drive legislation going forward. For states, I think they've continued to believe that sports betting taxes on marijuana are going to be lucrative, although they're very narrow tax bases. But that nevertheless, there's been a lot of revenue generation and new taxes expanding around that. And then the other piece is the city taxes, which Dylan covered. And in those cases, it's looking at payroll, property, gross receipts taxes administered at the city level to be able to generate funds from their loss of businesses in cities such as San Francisco and Portland. So thank you for participating today. We welcome any of your questions, which we can answer after this session, and hope you all have a great day.
So here is their contact information if you need that. It was also in the handout. We thank everyone so much for attending. Thank you to our presenters, and we hope everyone has a